Welcome to the Retirement with and On Purpose podcast. I'm your host, Trevor Lawson, and this show is all about helping you not just reach retirement, but truly thrive in it. You've put in the work, now let's make sure you can enjoy every moment to the fullest. Today's episode introduces a multi-part series on different cognitive biases. So cognitive biases impact all of us in our thinking, but I'm going to really hone in on how it impacts our thinking from an investment standpoint. And what prompted this idea for this series is a recent publication from one of our investment teams at Signature Investment Advisors. So in April of this year, when the market was very volatile, they published an article introducing a couple of cognitive biases for investors to be aware of. And so I'm going to revisit that publication today and talk about some of these biases for us to be aware of. So I'm going to quote this article throughout, and there will be a link to it in the show notes. But technically, the article, first and foremost, is called Beware High Watermark Thinking. And so technically, a high watermark refers to the highest peak value an investment fund or portfolio has achieved. However, beyond its technical application, the high watermark concept profoundly impacts individual investor psychology. I'll give you an example here in just a second. Many investors instinctively use their portfolio's highest recorded value as a mental reference point. When the market dips and the portfolio value falls below this peak, it feels like a loss, even if the portfolio has generated significant positive returns over the long term. So this was very timely because in April, again, the market was very volatile at that time. A lot of us were seeing paper losses on our statements, but we were coming off of a 2-year very good run in the market. So many investors had seen all-time highs lately in their accounts. And so when this volatility kind of reared its head, a lot of us, myself included, attached our portfolio's value to that recent high watermark, making volatility, which is very, very normal and will continue to be a part of the investor's journey, feel a lot more impactful and dire because we were coming off of that recent high watermark. So this feeling, I'm quoting again, this feeling is primarily driven by two powerful cognitive biases. And so these cognitive biases, I'm going to introduce two today, and again, several more over the course of the next couple of weeks, just helping us be more aware of how these play into how investors think about their money. Loss aversion, a cornerstone of behavioral finance. Loss aversion describes the tendency for people to feel the pain of a loss roughly twice as strongly as the pleasure of an equivalent gain. And that's, if you think about $100 and you and your buddy are betting, and you may find it a lot more difficult to lose $100 than you would pleasurable for winning $100. That's loss aversion in a nutshell. Most of us find it, we get much more attached to an item when someone's going to take it from us than we do when someone gives us, that same item. The other here that impacted the high watermark thinking was anchoring bias. So investors often anchor their expectations and perceptions of value to a specific reference point, in this case, the peak value of their portfolio. Subsequent performance is judged by this anchor, making any value below it seem inadequate or like a failure, regardless of the broader context. So again, this was all too timely in April of this year when we were coming off a very, very good run in the market. It was easy for all of us to get anchored to those high watermarks that we were seeing, those all-time highs, making a very normal pullback feel that much worse because our minds started to anchor to that new high point that we've seen in our portfolio. So some strategies to think about to overcome high watermark thinking and in turn these two powerful cognitive biases. One, zoom out. So embrace the long-term perspective. You always I feel like I'm beating a dead horse. Advisors always talk about the importance of the long term, and I'm sure clients get tired of hearing it too, but it's important here, especially with handling these cognitive biases. So instead of fixating on daily, monthly, or even yearly fluctuations relative to the most recent peak, focus on your portfolio's performance over much longer time frames, 5, 10, or even 20 years. Zooming out can really help the anchoring as well as that high watermark thinking. So zoom out, embrace the long term is one strategy. 4 others. So recognize your cognitive biases. So just being aware can really help us during these times of volatility. So that's my hope over the next couple of weeks, is to make you more aware of these cognitive biases. And maybe next time we experience a volatile patch in the market, you'll be more aware of your line of thinking around it. Third, stick to the plan, the power of discipline. A well-defined investment plan crafted alongside your advisor can be a valuable tool against emotional decision-making. Your plan should outline your financial goals, risk tolerance, time horizon, and target asset allocation. So have a plan and stick to it, the power of discipline. Fourth, resilience through diversification. A diversified portfolio across different asset classes, geographic regions, and sectors can help mitigate the impact of downturns in any single area. So diversification, again, it's redundant, but it's important because it helps smooth out the investment rod and really helps prevent these cognitive biases from getting in our way. And then lastly, just keep in mind, volatility is normal. Volatility is the price we pay for long-term growth potential. So what we experienced in April and what we'll experience again numerous times along our investment journey is very normal. And keeping that in mind, as well as being aware of these cognitive biases, can really help an investor stay in their seat and embrace the ride up over time. That's it for today. Thank you for your time, and I'll look forward to connecting again soon. Thanks for tuning in to the Retirement with and On Purpose podcast. I hope you're walking away with new ideas and a fresh perspective on how to make the most of your retirement journey. And remember, retirement isn't the end. It's your time to live with purpose. Until next time, I'm Trevor Lawson. Here's to a fulfilling and thriving retirement.